Donald Trump recently declared that Americans are experiencing the best stock market in 401ks in history. He's celebrating American excellence, pointing to record-breaking numbers as proof that the system is working. But if that's true, why does the average person feel poorer than ever? Here's the paradox. The markets keep hitting all-time highs, but purchasing power keeps shrinking. Groceries cost more, rent costs more, everything costs more. So where is all this success actually going? Imagine a scoreboard going up, but only one section of the stadium owns the points. The answer isn't in the headlines, it's in the ownership structure hiding beneath them. We're going past the celebration to ask the question no one wants answered. Who actually owns this so-called greatness? Here's the number that changes everything. The top 10% of Americans now own 93% of all stocks and mutual funds. That's according to the Federal Reserve's distributional financial accounts. Not 51%, not 60%, 93%. That means when the market hits a record high, more than 9 out of every $10 in gains flow to the wealthiest slice of the country. And within that top 10%, the top 1% alone owns over 50% of all stocks and mutual funds. Half of the entire market concentrated in the hands of the wealthiest 1%. The bottom 50% of American households, they own just 2.5% of total wealth. Same Federal Reserve data. For them, a record market is a headline they scroll past while checking their bank balance. It's not their reality, it's someone else's. Ask yourself, if the market doubled tomorrow, how much would your personal net worth change? This isn't random, it's a predictable outcome of how the system is structured. Think about what this means. When Trump points to stock market records as evidence of prosperity, he's technically correct. The numbers are real. The S&P 500 is higher than it's ever been. But those gains are concentrated in the portfolios of people who are already wealthy. For the majority of Americans who don't own significant assets, those records might as well be happening on another planet. Now let's look at participation. Here's where the gap becomes visible. Among households earning over $150,000 a year, 95% participate in employer-sponsored retirement plans like 401ks. They're in the game. They have skin in it. But for households earning under $15,000, only 40% can even afford to buy in. The entry cost to this best stock market in history is already out of reach for millions. And in 3 minutes, I'll show you why even people who are invested often don't benefit the way they expect. Here's where it gets uncomfortable. The mechanism driving these record markets isn't primarily innovation or productivity. It's asset inflation driven by monetary expansion. When the Federal Reserve pumps liquidity into the system, it doesn't raise wages. It raises the price of assets, stocks, real estate, bonds, the things that wealthy people already own. Wage earners benefit far less from asset inflation than asset owners do. They watch the cost of living rise while their paychecks stay flat. Meanwhile, asset owners see their portfolios climb without lifting a finger. The gap isn't closing, it's accelerating. The market is not a measure of prosperity, it's a measure of ownership. This is the invisible hand at work. The structure isn't broken. It's functioning predictably for those who own the assets. The real world Trump referenced in his statement? For most Americans, that real world is defined by stagnant wages, rising costs, and the growing realization that the success story they're being sold doesn't include them. The market isn't a reflection of broad-based prosperity. It's a reflection of who holds the chips. Think of it like a casino where 90% of the chips are owned by 10% of the players. When the table wins, who actually collects? And right now, the top 10% are holding nearly all of them. So when we hear about the best stock market in history, we need to ask a different question. Best for who? Because the answer determines whether we're celebrating shared success or just watching wealth concentrate at the top while the majority treads water. The data points in one direction. The ownership gap is real. And the uncomfortable truth is that record markets don't mean what most people think they mean. They mean the people who already had wealth now have more of it. That's the mechanism. That's the system. But here's the twist. The 401k is supposed to democratize wealth, right? It's supposed to give everyday workers a piece of the action. Even if you do participate in the market, does the structure actually work in your favor? Let's follow that money and see if the promise holds up. The 401k mirage, average versus median. The 401k was sold as the great equalizer, the retirement vehicle that would let ordinary workers build wealth alongside the executives. Put money in, get the match, watch it grow. Simple, democratic, fair. But the numbers tell a different story. The average 401k balance in America is around $134,000, according to Vanguard's participant data. That sounds reasonable, right? Enough to suggest the system is working. Enough to validate the idea that anyone who participates can build a decent nest egg. Now watch what happens when we switch from average to median. $35,000. That gap should make you stop. The average is nearly 4 times higher than the median. What that means is simple. A small number of massive accounts are dragging the average up, while the majority of participants are sitting on balances that won't come close to funding retirement. This is the mirage. When politicians and financial institutions talk about 401k success, they're pointing to the average. They're using a number inflated by the top earners to make the whole system look functional. But medians don't lie. Half of all 401k participants have less than $35,000 saved. That's not a retirement plan. That's a few years of expenses if they're lucky. So why does this gap exist? Because the 401k system is built to favor high earners from the start. Employer matches are structured as percentages of salary. If you make $200,000 a year and your employer matches 6%, that's $12,000 in free money annually. If you make $40,000 and get the same 6% match, that's $2,400. Same percentage, wildly different outcomes. Over decades, that gap compounds into the chasm we see in the data. Then there's the contribution limit. In 2024, the maximum you can contribute to a 401k is $23,000. High earners can max that out and still have money left over. Low earners can't get anywhere near it. They're contributing what they can afford, which is often just enough to capture the match. The system rewards those who can afford to save more, which means it rewards those who are already earning more. Now add in the fees. Target date funds, the default option in most 401k plans, charge management fees that eat into returns. For small accounts, those fees represent a larger percentage of the total balance. A 1% annual fee on a $500,000 account is painful. On a $20,000 account, it's devastating. The system extracts value from those who can least afford to lose it. And then there's the hidden tax that no one talks about. Inflation-adjusted returns. Sure, your account might show a 7% nominal gain in a given year, but if inflation is running at 4%, your real return is only 3%. For large accounts, that's manageable. For small accounts trying to catch up, it's the difference between building wealth and treading water. The uncomfortable truth is this: the 401k wasn't primarily designed to democratize wealth. It was designed to shift retirement risk from employers to employees. Pensions guaranteed income for life. The employer carried the risk. The 401k flipped that. Now the employee carries the risk, the market risk, the longevity risk, the inflation risk, all of it. So when we hear about the best 401ks in history, we need to ask the same question we asked about the stock market. Best for who? Because the average is a marketing number. The median is the reality. And the reality is that most people are nowhere near where they need to be. Here's the part nobody mentions. The hidden engine, currency debasement and buybacks. And this next mechanism is where even financially literate viewers usually say, wait, what? So if the market isn't working for most people, why does it keep hitting records? The answer lies in 2 mechanisms that operate mostly out of view: currency debasement and corporate stock buybacks. These aren't side effects, they're the engine. Let's start with the Federal Reserve. Since the 2008 financial crisis, the Fed has pumped trillions of dollars into the financial system through quantitative easing. You can see this in the Fed's own balance sheet data. This was done to stabilize the financial system, but it also had the side effect of inflating asset prices faster than wages. When you flood the system with new money, that money doesn't flow evenly. It flows to assets first: stocks, bonds, real estate, the things that people with capital already own. This is monetary expansion and asset price inflation in action. The dollar in your pocket doesn't disappear, it just buys less. Check the Bureau of Labor Statistics purchasing power data. if you want the numbers. Meanwhile, the assets held by the wealthy appreciate in nominal terms. Their portfolios grow not because the underlying companies became more valuable, but because the measuring stick, the dollar, became smaller. Wages have risen in nominal terms, but often not fast enough to keep pace with asset prices and living costs. A significant part of the market's rise comes from currency dilution and liquidity expansion. And if you don't own assets, you're on the wrong side of that equation. Now layer in corporate stock buybacks. Between 2020 and 2024, S&P 500 companies spent nearly $4 trillion buying back their own shares. That's according to S&P Dow Jones Indices buyback reports. Buybacks are legal and common, and sometimes justified, but their scale today changes how much they influence prices. That's not investment in growth. It's not research and development. It's financial engineering designed to boost stock prices by reducing the number of shares outstanding. Here's how it works. When a company buys back its stock, there are fewer shares available. Earnings per share go up even if total earnings stay flat. The stock price rises. Executives with stock-based compensation get richer. Shareholders see gains, but nothing fundamental about the company has changed. No new products, no innovation, just fewer shares chasing the same earnings. Now, to be fair, markets also rise because companies grow, innovate, and earn more. Productivity matters, profits matter. But when liquidity expansion and buybacks dominate price movement, ownership concentration determines who benefits most. This is the hidden mechanism. The market keeps hitting records not because the economy is thriving, but because the system is designed to concentrate gains at the top. Currency debasement benefits those closest to the money printer: banks, financial institutions, asset holders. Stock buybacks benefit executives and large shareholders. Wage earners get neither. The uncomfortable truth is that record markets are significantly driven by monetary policy and financial engineering, not primarily broad-based prosperity. The structure isn't broken. It's working predictably for those positioned to benefit. The question is, intended for who? Whose excellence? So here we are. The best stock market in history is technically true. The numbers don't lie, but they also don't tell the whole story. The top 10% own 93% of the gains. The median 401k balance is $35,000. Asset inflation rewards asset owners, while wage earners watch their purchasing power erode. Corporate buybacks artificially inflate stock prices while wages stay flat. Headline success and household success are not the same thing. The structure tends to concentrate gains at the top. That's not a bug. That's how it functions. So what happens when the bottom 90% realize the success isn't theirs? What happens when the gap between the headline and the reality becomes impossible to ignore? That's the question we're left with. No easy answers. Just the clear-eyed recognition that the system may be working, just not for the people who think it is. And for most people, they're standing on the outside looking in.